Do you ever feel like your finances are controlling your life? Like you're working hard but never make progress towards your financial goals? Have you ever caught yourself thinking about how nice it would be to achieve financial independence and build wealth for yourself and your family? I'm sure many of you will know these feelings, and it's easy to feel like everyone around you is getting rich while you're stuck in the same old routine. The good news is things don't have to be this way, and you don't even have to rely on luck to make your financial dreams a reality. There's no need to win the lottery or to find the next hot stock or cryptocurrency to escape the infamous rat race. With the right mindset, the right investment strategy, and a bit of know-how, you can absolutely reach your financial goals. So in this video, I'll share 5 timeless and fundamental pillars of a smart wealth building philosophy that I will apply for the rest of my life, and I suggest you do too. Alright, now this video was actually inspired by the infamous Twitter thread by the internet phenomenon Naval, titled How to Get Rich Without Getting Lucky, in which he outlined some fundamental personal finance and business principles. And I wanted to apply this concept to the world of investing and stocks, because I truly believe that if you are investing in stocks and get some of the most important decisions right, you can't help but get rich, at least if you live a long enough life. So let's jump right into the first principle that you need to follow, and that's to start early. Starting to invest early is important because of the power of compounding. Compounding is the process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. And the earlier you start investing, the more time your investments have to compound and grow. So for example, let's say you invest $1,000 a month at a 9% annual return, well then after 15 years your investments would be worth $378,000. However, if you had started investing 10 years earlier and had 25 years to let your investments grow and compound, your net worth would already exceed the magic $1 million threshold. Starting to invest early also allows you to take on more risk because you have a longer time horizon to weather any short-term market fluctuations and volatility. This means that you can invest in assets with higher expected long-term returns, such as stocks, which tend to have more volatility in the short term, but historically have delivered higher returns over the long term, as highlighted by this table here. And as this graph here shows, over time the US Dow Jones Index saw many flat return periods that lasted for many years, up to 30 years between 1929 and 1959. And of course, these so-called lost decades of disappointing returns are hard to stomach. However, the historical record also shows that these difficult periods have been followed by stretches of significant price recovery, as shown by this great chart from David Advisors. That's quite simply because as long as the earnings power of the companies goes up, lower prices simply mean higher expected future returns. Or put differently, markets that are flat for a long period of time can actually make investors significant returns in a fairly short period of time once the market sentiment turns. But obviously, you can only stomach these periods of low or negative returns if you have that long-term investment horizon, which you can only have if you start early. Alright, my second piece of advice is to be obsessed about learning as much as you can about investing and personal finance as early as you can. Because knowledge, just like the interest you earn on your money, compounds. Now, I'm obviously in the early stages of my wealth building journey. I'm only 32 and I've been investing in the stock markets for around 5 to 6 years now. And of course, I'm still learning a lot myself. And in fact, I think the process of learning never stops. But especially in the first 3 to 4 years, I was really obsessed about learning as much as I could about investing and personal finance. I was reading books, I was listening to thousands of hours of podcasts, I was building spreadsheets, I started a YouTube channel, and in fact I even wrote 3 investing books. Now why does this matter? Well, earlier we were talking about the power of compound interest, and there are a few key variables that will determine the long-term financial outcome of your investments. The one that we addressed in the first principle was the time that you are investing for. However, another variable that you can try to influence is your compounded annual return. As my regular viewers will know, I'm investing actively, meaning I try to pick individual stocks as opposed to investing in a broad market ETF. And by doing that, I try to beat the market. Because if I could increase the compound return from 9% to 10%, for example, if we stick to the example we used previously, well, after 25 years, this would make a difference of more than $200,000 if I still invest $1,000 a month. So not only have I put a lot of effort into trying to understand basic personal finance concepts, such as finding the right budgeting approach, the rent or buy debate, or other big life expenses like insurance or cars, but I've also learned how to read financial statements and annual reports, how the best value investors invested their hard-earned money, and I try to master fields such as competitive advantage analysis, the analysis of management teams, how to value companies, portfolio management, or behavioral finance. Now, of course, this is very time-consuming and intimidating at first maybe, which is why I think very few people actually put in the work. But you need to get this done early on, because mastering these topics and truly developing a deep understanding of the importance of these concepts will most certainly bear fruits over the long run and give you a major competitive edge over those that are too lazy to get the basics right. It will allow you to make informed investment decisions, create a portfolio that generates solid returns, stay calm during market downturns, and in turn help you achieve your long-term financial goals. Moving on to pillar number 3, and I'll keep this one fairly short. Think long-term, be inactive most of the time, and avoid get-rich-quick schemes. In a way, we've already stressed the importance of long-term thinking and investing, but this is actually easier said than done. I guess what I want to stress here is that the road to wealth will be bumpy. We've highlighted that there will be stretches of disappointing returns, and not every investment that you will make will be a winner. Now, there will be a lot of losers too, and some of the best investors in the world are actually wrong rather frequently. As Peter Lynch has famously said, if you're terrific in this business, so the business of picking stocks, you're right 6 out of 10 times. It's similar to the venture capital approach. Because of the unpredictability of the venture capital bets, it's actually possible for a venture capital fund to be wrong more often than right, but still come out ahead because the right ones are so significant winners. So as long as your investment philosophy involves focusing on high quality businesses to invest in, focusing on their long-term development, being willing to wait for your long-term theses to unfold, and avoiding jumping on the latest trend and hype that promises to make you rich quickly, I can almost guarantee you that you will have a bright financial future ahead of you. Whenever you are tempted to invest in something speculatively, on something that seems too good to be true, remember that in life there are no get-rich-quick schemes, and it's usually just someone else who's getting rich off you. Okay, then the 4th pillar is to prioritize your health, because only then you will be able to enjoy your upcoming wealth. And I know that this point may seem redundant to some of you, but it's actually quite simple and I think super important. If you live a healthy life and thereby increase the odds of living longer, your odds of ending up extremely wealthy will also increase due to the aforementioned nature of compound interest. Did you know that Warren Buffett actually accumulated more than 90% of his net worth after the age of 65? If he had died at age 65, chances are no one would be talking about him today. Now, the final point that I want to mention before I get to one more bonus point is that you need to recognize and stay away from psychological pitfalls, psychological traps that may sabotage your investment success. Think of investing as the intersection between economics and psychology. As investors, we like to think of ourselves as these super rational, computer-like decision makers, while in reality we're actually chronically irrational, suffering from all sorts of cognitive biases. For example, we are anchored to past prices and stock prices as well, which will sabotage our buy and sell decisions as investors. To learn more about this specific type of bias, I recommend you check out the following video next. So mastering your own psychology is something that you should absolutely focus on. And while you may never become 100% unemotional in your decision making, becoming aware of your innate behavioral biases by studying the field of behavioral finance and actively avoiding these psychological Pitfalls is a must if you want to get rich through investing without getting lucky. Now finally, I'd like to stress that you need to define what the term rich actually means to you. I know that I have used the figure of $1 million in the thumbnail of this video. This may be a financial goal that you are striving for, but please acknowledge that you may be content with much less. And a rich life, of course, involves much more than hitting certain financial targets. I think the following sentences summarizes this idea quite nicely. Some people are so poor that all they have is money. So I think before you start your investing journey, it's worth actually writing down what your end state lifestyle that makes you happy should actually look like. What lifestyle does hitting your financial targets allow you to live? This may be traveling 3 months a year. This may be controlling 80% of your own schedule. This may involve having the financial resources to afford a home in nature or at the beach. This may be being in the top 1% of your hobby. And I'm sure you can come up with your own ideas, and I'd love to hear what you think. Please share your definition of success in the comments down below. And with that, I'll wrap it up here. Please watch the following video next. Take care.